on income tax updates and strategies to reduce your taxes in the new year. So this is a hybrid event, as you can see. So we have some members who are in the chamber conference room and others are on Zoom. We will have time for questions at the end of the program, so you can either type them in the chat box or just save them until later in the program. And now I would like to introduce our speaker for today's event. Barry Fields has over 20 years experience in tax consulting and auditing in public accounting and private industry. Barry is a partner with Bormel, Grice Huyett, where he has worked for the past 12 years. Barry is very active at the Chamber, serving on our Small Business Committee, and he will be joining our Board of Directors in the new year. Now I'd like to turn it over to you, Barry. Thanks for being here.
Good morning, Christy. Thank you, and thank you, everybody. If you Thank you for waking up and coming to a tax planning meeting. Sorry, but you're going to be going back to sleep shortly. And hopefully, like I said before, hopefully everyone has access to the handout. If you were here, we'd be handing it to you. Since you're there, it came in an email this morning as a PDF. I'll be referring to it. I'll be going through it. It's a 5-pager. I'm not going to be going through the whole thing. Some of it, I'll explain in a minute. It's really built in chronological order because of the various tax changes over the last 3 or 4 years. And if you get nothing else out of today, I highly recommend printing, even though we're paperless. I would highly recommend printing the handout, putting it on your nightstand, and at some point in the middle of the night, if you can't sleep, refer to it, and you'll fall back to sleep. So that's lesson number 1 today. Kim's going to help me out. I'm a little far from the screen, so if anyone has questions and you type them in, she'll let me know. I just ask, what we're going to do is, if I'm speaking about something and you have a question on what we're covering, by all means, jump in and type your question and ask your question, and we'll cover it as it's timely. And if you have questions, if you came here with a question already, or it's something I'm not covering at the time, let's save those to the end, please. And with that, I'm going to get started. So taxes there's been a lot of changes over the last few years. Some have been pretty large and some have been pretty nominal. Not everything affects everybody. So we're going to try to cover some things. The handout is, like I said, it's 5 pages, and it starts with the 2017 Tax Cuts and Job Act. That was, everyone calls those, the what do you want to call it? The Trump Tax Cuts or the Trump Act. But it's formally known as the 2017 Tax Cuts and Jobs Act, TCJA. That is the framework. It's the first 2 pages of it was the largest tax reform bill at the time in about 20 years. So I left this here, updated it a little bit for inflation numbers, but I generally left it because that's still our starting point. As a quick, if you want to flip down 2 pages, if you go to page 3, sorry, the pages are not numbered. If you go to the 3rd page, this is called the Secure Act. People almost forgot about this because this came in even before coronavirus started in December 2019. It was called the Setting Every Community Up for Retirement Enhancement Act. And these are still out there. Most of these rules, these are still there. We're going to cover them in a moment, but I'm just trying to give everyone the timeline a little bit first. That's the Secure Act, and that's page 3. There's some individual and business provisions. Then page 4 gets into what started happening in March of 2020, the first Coronavirus Relief Act. That was called the Families First Coronavirus Act. That was in March 18, 2020, was signed into law. And then soon thereafter, on March 27th, was the first big one, the first of 3, the Coronavirus Aid, Relief, and Economic Security Act. That one's known as the CARES Act. And then on the 4th page, we get into the American Rescue Plan Act of 2021. I'm not going to go too deep at all into, especially that 4th page, the Families First Coronavirus Act and the CARES Act, because a lot of those expired. A lot of that was 2020, effective 2020, for 2020. Some of it trickled into 2021, and we'll touch on those things. And a lot of these, if you didn't do it already, it's too late. So I don't really want to get into the detail of it, but it's still important to cover, because there are options to amend tax returns if you never knew about things. When I say too late, it's too late to do anything now for 2021. So we're going to start on the 1st page, but then we're going to jump to the last page, and then we're going to kind of fill in between. Bear with me on the jumping. It's just, I wasn't sure how to write this, and I just felt chronological as when the laws were passed was our best bet. Before I even go into the handout, I always end with this, and I realized maybe it'd be better to start with. there's the generic tax planning, 'cause that's part of what this is. This is, not just telling people what the tax laws are, but also giving some tips and ideas. There's the generic tax planning, which I generally cover with clients every year, mostly through December, that it becomes something where I joked with some coworkers the other day that I almost feel like everyone knows this. But then I realized that I live and breathe taxes. Most people don't, so it can't hurt to hear it the once a year. And some of it comes to me like, oh, I got it. People are going to hear this again. They keep hearing me say this. Well, maybe you didn't. So that's why it's important to cover. So we're in December of 20. We're in the end of the year. We're in December. It doesn't matter what year. Some of the generic tax planning ideas, and unfortunately, everything costs money. Anything you want to do to save taxes generally will cost cash. So you have to make a decision as an individual and as a business, what's more important, cutting my taxes or spending cash? And it sounds common sense, oh, save cash, but if you need certain things, if your business needs new equipment, for example, and you planned on doing it anyways, well, maybe now's the time to do it because you can get the tax cut now versus waiting for the following year to get the tax break. So what am I talking about? So if you're a business, it's December. A lot of businesses are cash basis. So you have your bills now, your December utility bill, your December technology bill, whatever your December bills are. Now, granted, you don't want to be late. Don't put yourself in jeopardy. But if you have certain bills that you pay now in advance, when I said December, but your January 2022 bills, if you've gotten it already or it will be, you can pay your January bills now in 2021 in December, and you'll get that deduction now this year in December. These don't really work yearly. It kind of works the first year you do it, because if you paid your bills in January, and you paid December in December and everything in between, that's 12 months. And then when you pay 1 month early now, that's 13 months. You'll get a break. But next year you have 11 months, unless you pay that next year's bill early again the following December. So generally only works once, and you're always ahead. So that is paying bills. There's also talk of what's going to happen with the Buildback Better Act. Is it going to be signed or is it not going to be signed? Are tax rates going up or they're not going up? We're not getting too into this. I'll highlight as I speak every now and then that certain things might change, but I'm not getting into it. But there is some thought that tax rates might go up. And if you're in that category where you think tax rates might go up, this would be the year to maybe not accelerate deductions in December now and save it for January if tax rates go up. And this is the hardest part with tax planning, is because we have no idea. We don't know what Congress is going to do. They're not playing nicely. They haven't for a number of years. So it's no one really knows. And I can't sit here with a crystal ball and tell people one way or the other whether tax rates will go up or won't go up. The one thing that does seem pretty certain is, regardless of what happens, if the changes are happening, they're adjusting a lot of things for income levels, where it seems like for married filing joint, if you're making 400,000 or more, maybe even 450,000 or more as your income, that those are the folks that are going to be affected by some of these changes with taxes going up. And if you're under that level, then good chance your taxes won't go up. So just keeping that in mind, because it kind of changes the pool of who it might impact and who it won't impact. So just because you're reading the headline, ooh, taxes are going up, there's a good chance most of us, it's not affecting most of us. So if you're in that category, it's something to think about. Call your tax planner, call me. So moving on, first page of the Tax Cuts and Jobs Act, first page of the handout is the Tax Cuts and Jobs Act. I'm not going to read this. I'm not going to go over every little detail. I'm trying to keep an eye on the clock. The first section is the tax brackets. They were all reduced with, they were changed from the old law to the new law. The old tax bracket, the highest bracket was 39.6%. Now the highest bracket is 37%. And for everybody, where you would have hit the last on the old brackets to where you are now, you're probably in a lower bracket with a larger spread between brackets, so that in general, from the brackets perspective, between 2017 Tax Act and before that, most people's taxes went down just from these brackets. Some people lost deductions, other things may have happened in the fine print, but from just the rates perspective, most people's taxes went down. These numbers you see are based on what's called taxable income. You take all your income, you add it up, your wages, your dividends, your interest, your lottery winnings, other things, and you add that up, and that's called your adjusted gross income. That's not these numbers. You can't just look at your salary, look at that number and say, what bracket am I in? Then you take from adjusted gross income, you take deductions. For most people, it's the standard deduction, which we'll cover in a moment. And for a lot of other people, it's itemized deductions. And there are some other things in between that we're not going to cover, but you take your adjusted gross income, less itemized deductions or standard deduction, and you generally arrive at taxable income. It's more complicated than that, but this is the simplest way to cover it right now. And you take that and you look at your number. For example, if you're, and I'm trying to explain excuse me, what is a deduction worth? That's what I'm trying to get to, because we're coming into itemized deductions versus standard deduction. If you're married filing joint in 2021 and your income is 172,750, I'm purposely picking that number. That's the second row. That's the beginning of the 24% bracket. If your taxable income, if you're in that, if you're anywhere between 172 and 329, that's a pretty big spread. That was the new, it was a much smaller spread to get into the 30s under the old law. But if your taxable income is roughly $175,000, married filing joint, so that's two of you, then you're in the 24% bracket. So for every dollar you spend for a deduction, you'll save 24%. You'll save, for every dollar, you save 24 cents in tax. So that's what I was saying before. You need to decide, is it worth spending the dollar or saving the dollar? Because even though you saved 24 cents in tax, you spent 76. So it's up to you. It's up to people's personal preferences. I say that because we're leading into the second bullet, the standard deduction. Under the old law, the standard deduction was about $6,300 for singles, about $12,700 for married filing joint. It's always been adjusted for inflation, so it's always gone up a little bit. It is now, in 2021, if you're single, it went from $6,000 and changed to $12,550 in 2021, and it went from $12,700 under the old law to $25,100 under the new law. So that's a huge jump. So if you're not itemizing, and you're doing taking what's called the standard deduction, you get a $25,100 deduction right off the top. And most people, they did this as part of the simplification. It rules out a lot of people for itemizing, and most people take the standard deduction. That's $25,001. Will I itemize, or will I take the standard deduction? That gets us to the next couple bullets. The largest three deductions that you're allowed as an itemizer is what I call them the big three. It's your mortgage interest, it's your state and local income taxes, and it's charitable contributions. One of the things the law did was it capped state and local taxes at $10,000. So you're allowed $25,100 as a standard deduction. We're trying to compare this to itemizing. Well, you're allowed a cap of $10,000, and most people in Maryland are at the 10. I shouldn't say most. Most people married filing joint, both taxpayers working in Maryland, kids in school, etc. You're generally, if you own a home, you're generally in that 10,000 bracket, because that covers real estate taxes also. So it covers individual income tax, state income tax, spouses, state income tax, plus real estate taxes, your house. You cover those three, you're generally at $10,000 in Maryland. So now to get to the itemized line, you got to spend another $15,100 before you can deduct your first dollar itemizing. We have home mortgage interest. Some people don't have a mortgage. Some people it's $2,000 or $3,000. Some people bought a home recently and it's in the 10, 12, 13,000. It really depends on people and their particular situation. Good morning.
Good morning.
Let's just use 10,000 as a rough ballpark. It's a little high, but it's a nice round number that jumps. So we just talked about 10,000 for state and local taxes. If you have mortgage interest of 10,000, that brings you to 20. You're still not itemizing. You're taking the standard deduction. You now need to spend 5,100 in charitable contributions to get to 25.1. And that's something for each their own. Some are bigger givers than others. So hopefully everyone's with me by now. It's kind of hard, looking at screens with I have Kim here And someone just came in, so not quite sure if everyone's following me or not. Good morning. So then we get to the charitable contributions, like I said, of 5,100. Those three are what I call the big three. You add those up. General rule of thumb is look at last year's tax return. You're roughly the same as last year of how many what your deductions are. Your mortgage interest will go down a little bit. So that covers. I kind of just talked about the itemized deduction for state and local, the deduction for mortgage interest. Just so you know, if you have a home from before December 15, 2017, you're allowed your interest on $1 million home plus $100,000 line of credit is usually what you were taking. That was 1.1 million. The new rule brought that $1 million home, your mortgage on, and it could also be a second home, but it's up to a total of debt of 750,000 is what it's allowed now. The interest on 750,000. If you have an older home and before 2017, you refinance, you're still okay. It's when you buy a new home that brings you over that limit. And the home equity line of credit rules changed that the home equity line must be secured by your property, and you're capped at the 750. It's no longer the 1.1. If you're already at $1 million on the old rules, if you're already at $1 million, you don't get that extra 100 on a home equity line of credit. And you can't borrow the money from a family or a neighbor or anything. That must be secured by the home. And so a lot of people's interest deductions are going to start going down. The rates are low. The total amount you can finance is lower. So that's going to stop. So again, we're back to, do I itemize or take the standard deduction? On the charitable contribution side, one thing that they did last year for 2020, they allowed all taxpayers $300 to itemize, non-itemizers. You're taking the standard deduction, and you're allowed a $300 on top of that charitable contribution. For 2021 only, they expanded on that. Was a 2020 only rule, and they made they expanded on that for 2021 with one of the coronavirus relief acts, where singles can take 300, can deduct 300, and married filing joint can deduct 600. So it's almost like every individual can get 300 each. A husband and a wife can do 600 in total. So if you do any charitable giving and you take the standard deduction of 25.1 plus that 6, now you're at 25.7 before you even start itemizing. So again, it's taking a lot of people out. And last but not least, those are what I call the big three, and the fourth one is medical. If you're in a high medical, if you have health issues, and a lot of elderly people are in this category to begin with, just between health or even if they're in assisted living and retirement communities, the health side covers some. The rule was always 7.5% of AGI. Remember, we talked about adjusted gross income earlier versus taxable income. It's 7.5% of your adjusted gross income before you can deduct the first dollar of a medical bill. So if you have $100,000 of adjusted gross income, 7.5% of that is 7,500. You need to have more than 7,500. You could only deduct the amount over 7,500. The point of this one is everyone has some medical bills between their insurance premium, if it's not covered by work, and other medical out-of-pocket expenses. Everybody has some. The government's not going to finance and fund your entire health bill, but if it's getting higher, they're willing to help people. Then the individuals get breaks. So it's when it's over 7.5%. We're not going to go through the timeline, but it was set to go from 7.5% to 10%. It got suspended again, and now it's permanently back to 7.5%. Another big change was expanded the child tax credit. Under the old law, taxpayers under certain income limits, and it was into the 400,000 range as income, got a $1,000 tax credit for each child under 17, $500 for over 17, up to I think it was 24 years old. That was 1,000. The 2017 Tax Cuts and Jobs Act changed 1,000 to 2,000, and I'll talk about it in a moment. We're gonna jump pages any second. But it's now $3,000 per child temporarily for 1 year, 2020. But hold that thought just to quickly cover the last bits of the 2017 Tax and Jobs Act. Some of the things that have not changed in the last few years. 529 plans. I'm going to the fourth bullet on the second page. It used to be 529 plans. You can only contribute, save money for secondary education. That's college and graduate school. And now you could also save it for private school, religious school. You could be in elementary school, middle school, high school. Obviously, this wouldn't be for public school students, but this would be for private school students. You could use 529 money for private school. Keep in mind that odds are it's only you're limited in Maryland. It's 2,500. In the Maryland plan, you get a deduction of 2,500 per year before it caps out. So the amount you can save, and the IRS, it's 10,000 per student. So there's a good chance you're going to use your 529 money in private school and not have anything left for college, depending on how you spend your 529 plan money. Moving on to just the business, that was the individuals. Oh, and all of this expires in 2025. Even with all the different coronavirus relief acts, these things we just spoke about revert back to the 2016 tax laws in the year 2025 for individuals. For businesses, most of these were all made permanent. The corporate tax rate, that's the big one. The highest rate was 35%, and now it's 21%. And that's what you may have heard in the news. There's a lot of talk of possibly in a new tax law increasing that. Maybe, maybe not, 21 to 24, 25. We're dealing with congressional negotiations that are just not worth discussing. So just right now, the corporate tax law, the rate is 21%. And that is for what's called C corporations, not just Microsoft and Facebook, but also smaller companies that are taxed as what's called a C corporation. If you're an S corporation, that passes through and you're taxed at individual rates, which was the first page. So the Tax Act was 21%. Trying to level the playing field, Congress came up with a very complicated concept called the qualified business income deduction, which allows a 20% deduction on pass-through income. Like I just stated a moment ago, an S corporation and also a partnership is a pass-through entity. And so if you have income from your self-employed business, as it has to be an LLC, a partnership, or an S corporation, that income is carved out from your individual income and you get a 20% deduction. And the idea was they're trying to level the playing field a little bit between C corporations at 21% and pass-through entities who are being taxed at individual rates, the highest being 37. They were trying to bring that business income alone, just the business income, at a lower tax rate. It's about the third or fourth year this is in play. So if it applies to you, you probably know about it. The rules are pretty complicated. There are limits. We're not going to go into all that today. But also there are some proposals floating around as trying to simplify that a little bit. And again, anything floating around, they're trying to do under 450,000 of income. They're trying to make things not phase out, straightforward. You get the full deduction, and then over that number, things start changing. So that's the qualified business deduction. Another big one for businesses, and this is what we were talking about at the very beginning with should I spend money or not spend money. For equipment is whether it be computers, phones, right here the equipment for Zoom, the cameras now that wasn't around 3 years ago. You can deduct that as a business in one of two, and this is businesses, not individuals. You can generally deduct it in one of two ways. You can follow the regular depreciation rules, and which is generally over a lifetime of anywhere from 5 or 7 years. Generally, most property is 7 years, computers are 5 years, and software is 3 years. We're not going to get into all the different rules and lives. I'm just kind of giving examples of some of the complexities. Furniture in an office is 7 years, but if you buy a new desk, if you buy for your office, not your home office, but for your business, you can depreciate it. You can deduct the cost of it. There's something called Section 179. You must have taxable income for this, and if you have income, you can deduct it all 100%. And you're limited to about $1 million deduction. So the big corporations use this. Then what came in law, we don't see this as much because you're also allowed what's called bonus depreciation, which is a separate set of rules, and you can also depreciate your items, your equipment 100% under that rule. So either way, you generally get a 100% deduction on your purchases. So the question is, I have income. My income in 2021 is up. I'm trying to shelter it. When I say shelter, I'm trying to reduce it. Shelter has a negative connotation, but as long as you're following the rules, there's nothing wrong with it. I'm trying to reduce my income. I need computers. I know this. I wanted in January or February, I plan on buying new equipment for upgrades in the office. Should I do it now in 2021 in December, or should I wait till January or February? Well, you get a deduction now, and so that's one of the trains of thought is anything you do now to save taxes this year and you worry about next year. Those are all cash, based on personal preferences, based on your particular situation. Buy some now and more, and sell, buy more later. There are many options. It's really each person's fiscal need, but like I said earlier, lowering taxes costs cash. There are also, if you buy a car, an auto, I'm moving on to the next bullet. You are allowed to take accelerated depreciation for your auto. There are limits though. You can't just buy a car. Now there's if you have a fleet vehicle, if your business uses vans that are owned by the business that are only shipping, if you're in the shipping industry and you're shipping or you're delivering and they're owned by the business, there's no personal use and it's only used by the business. Those are almost considered like regular equipment. You can get 100% deduction for those. The rule I'm talking about here, where it says depreciation limits on autos, that's when you have personal use. I have my car. I'm a doctor. I use my car for personal. I go out for dinner. I go to work. Commuting to the office is personal. It's called commuting. It's not a deduction. But I also, after I'm at the office, I go to the hospital every day, several times a week. I do house calls. That's rare now, but those are the old days. Whatever it is, you're a financial planner. You're going to clients. You're meeting clients on site, or you're in sales of some form and you're driving around, but you're using the same vehicle for personal. That's when these rules come in. This next thing where it says the limits. The 2020 limits are in the first year, you can take $10,200 deduction and $18,200 if you use what we call bonus before. And then the sliding scale each year thereafter, you can depreciate over 5 years, but you get a bigger boost up front. And that goes into the same discussion we had a moment ago with, should I buy new equipment? Again, you're a business, you have a car, you know you need a new car. Should I buy it this year or should I wait till next year? You'll get a benefit if you buy it this year, but you may want to wait. The last thing I really want to talk about, I'm going to jump down a couple bullets, is business the deduction for meals and entertainment. This has been a big discussion. The Tax Cuts and Jobs Act in 2017 eliminated the deduction for entertainment, and it limited the business, and it also reduced the meals deduction. What is entertainment versus what is meals? If I take a client out to a baseball game, the game ticket is entertainment. It used to be 50%. I think the policy behind that 50% was I don't get to deduct me, but I get to deduct you. So I get a 50% deduction. But if I take 5 people, it's still 50%. So that doesn't really work when it's more than 2 people on the rationale. But there is always a personal use side to go into these things. Why should there be 100% deduction for going out and doing something fun on the entertainment side? Why should taxpayers pay for the whole bill? So entertainment is, going to play golf. A few folks go out and play golf for the day, and someone picks up the tab. That's entertainment. That is no longer. That used to be deductible 50%. That is not deductible. The games and golf are the obvious, but there are many other examples of what you can be doing for fun, for business, and it's no longer allowed. The deduction for meals got severely curtailed under this rule, and that is the rule. That's why I started with these first 2 pages. In 2020, they came out with a new rule that's good for 21 and 2022. We're at the end of this year, but it's still in play for all of next year. Businesses, this is not individuals, it's not part of the itemized deduction, the standard deduction, the itemized. Businesses, for business purposes, can take a 100% meals deduction for taking clients, it's not just clients, vendors, suppliers, customers, all those different words. If you take people out for dinner, lunch, whatever, you get a 100% meals deduction. The rationale for this wasn't so much trying to support me to take you out for lunch, it was trying to help the restaurant industry that got hit so hard in coronavirus. And there is some fine print to this. Coffee shop, cup of coffee does not apply. It has to be a meal. Convenience store, running through 7-Eleven, grabbing coffee and some chips, and then eating in the parking lot with you, that is not a meal. It has to be a restaurant that it's the, servers, your typical standalone restaurant. Alcohol is included. That's part of the meal, but it has to be a meal. One good caveat is, and again, because of coronavirus and everything's shut down or limited, it can be a takeout meal. It doesn't have to be in the restaurant. You can take it to go. You can't. It's not for yourself. It's not for me to have lunch and eat in my car, eat in my office, and take 100%. There needs to be a business purpose with somebody else. And what I always tell people is, if you do this on the back of you always want to be able to document the who, what, when, where, why, and how. Generally the receipt is the when. It has a date and time on it. The where, that's generally on the receipt. But then you want to know who. Who else were you with? I was with Kim, and we were talking about, and why. We would talk about chamber activities. And that way you don't have to think about it later at the end of the year as you're gathering up all your invoices and your receipts. And there is now a 100% deduction for that. That is good for 21 and 22, and then we revert back to the older rules starting again in 2023. And I just want to go back a little bit. If you have net operating losses, if your business, because we saw an uptick of this with coronavirus. If you have net operating losses, the old rules were, your business has a loss, and your loss offsets other income. I'm self-employed. My self-employment income is a loss. My wife is an employee. She has a W-2. My loss can offset her income. If my loss is so great that it offsets everything, that's called the net operating loss. The old rules were you're allowed to go backwards. I could amend last year's return or file certain forms to get a rapid refund and go back last year or even 2 years. The Tax Act in 2017 prevented carry backs, and it was only carried forward. They suspended the carryback rules. This is a unique set of people who this qualifies for. I'm not going to get into the details. Excuse me, but I just wanted to point it out. For 2020, you can take losses back again, but in 2021, you cannot go backward. They only go forward. I just want to differentiate that between one of the coronavirus relief acts allowed you to carry it back temporarily, where in 2021, you could only go forward again. So that generally covers the framework of where we're at in the tax laws with some of the changes that apply to them. Going on to the third page, the Secure Act. This one, for a lot of people, really got lost in the shuffle because this came out in December 2019. It was talked about a little bit in January of 2020, and then Governor Hogan sent everyone home in March of 2020. So this sort of got lost in the shuffle, but these rules are still out there. This does not expire. Like this is a completely different act than the 2017 Tax Act. This is independent and separate from all the Corona Relief Acts. So there used to be a maximum age to contribute to your IRA, your traditional IRA. It used to be, folks are working longer now. Folks are older, we're working longer, and we're retiring later. So it used to be that even if you still worked when you were 71, 72, 73, you could no longer contribute to your traditional IRA. That is not the case with this. It removed that ceiling. I'm not recommending anyone, this is whether or not you work an extra year when you plan on retiring, this may not change that much, but just know if you're still working as you're getting older, you can still contribute. This is a traditional IRA. This is not a 401k plan. This is not a 401k plan or other retirement. This is for a traditional deductible IRA. It used to be the required minimum distributions as you were retiring were taken in the year you turned 70 and a half. Well, first of all, that rule alone was complicated. When do you turn 70 and a half? Good news is we don't have to discuss it anymore. You need to take required minimum distributions in the year you turn 72. So everyone can save, you get an extra year, in some cases 2 years of saving in your retirement plan before you must start taking distributions at 72. And this is based on annuity tables and charts. It gets pretty complicated. Just know if you're at that age, if you're at 70, 71, and you're starting to, and you've been thinking about retirement, 72, you need to start taking distributions. In 2020 only, for again, one of the Corona Relief Acts, especially when the stock market started plummeting, in 2020, they suspended that. You did not have to take, no matter what age you were, you did not need to take a required minimum distribution in 2020. I've been asked several times this year, is that in effect again for 2021? And no, it's not. If you're required to take a minimum distribution, if you were before, or if you're required to start, you're turning 72, you are required. So anyone who thought that's being pushed off, it's not. So you must take required distributions. I'm going to move on. Those are generally the personal deductions required to the Secure Act. And I'm not going to get into the details, but if you're an employer and you want to offer a 401k plan or some other retirement plans, there are some beefed up benefits as far as deductions and credits available to try to encourage employers to offer plans to employees. That's one, I'm not going to get into the details. I'm happy to talk later about that. Or if you have a financial planner and someone you work with, talk to them regarding the enhanced benefits. That's the third page. Going on to the fourth page. This one we're not going to cover so much. We're just going to cover some ideas as far as the details. If you remember, this time we're into like a year and a half at this point. January 2020, no one even thought about this, and then suddenly March 2020, things were starting to get shut down. Governors and we're sending everyone home. And that's when the first Coronavirus Relief Act came out. Everything was generally at that time, a lot of it was tax credits on unemployment taxes was how the first round really kind of went, requiring folks to give leave. The federal government was requiring folks to offer leave to employees that didn't otherwise have it as a result of, obviously because of coronavirus, and to offset that, they were giving tax credits on employment taxes. Then we realized, quick soon after, this is bigger than we thought. So they enacted the CARES Act. The CARES Act brought in the Paycheck Protection Program. Those were the forgivable loans. If you have not applied yet and you just heard about this, it's too late, sorry. But there was the coronavirus, the CARES Act had a round, and then there was a second round later in the year for another round of Paycheck Protection Program loans. Those were all forgivable. If you have not gotten yours forgiven yet, I believe a 2020 loan might be too late. 2021 may not be too late. If you have not, dotted your I's and crossed your T's and taken this over the finish line, I highly recommend you do that as soon as possible because the window to get forgiven is closing. And that's generally all I'm going to talk about on that, except that just everyone know that if the loan itself that's forgiven is not income, and the expenses that it was subsidizing is deductible. So you got cash and you're allowed deductions, and it was people I spoke to, it was a lifesaver. A lot of clients with restaurants or any business really, this was a lifesaver. It kept people open through the worst of it, and it really did what people wanted. For all the negative press there was a round of negative press. Certain businesses got huge loans, but they weren't really small businesses and what it was meant for. That's unfortunate. Hopefully there may be some clawbacks, maybe not. But the bottom line is the everyday taxpayer, the everyday business that needed this, it was a lifesaver. I should say a business saver. Then there was also the employee retention credit. That's the second bullet on the fourth page under the March 27 CARES Act. That was, again, a payroll credit of up to $10,000 to retain employees. So people weren't working. You were paying your payroll taxes, you were paying your employees to not work, and the government was giving you a credit against your payroll taxes up to $10,000 per employee to not work and to continue paying them. That was very well received as well. A lot of businesses were able to take advantage of that. That wasn't nearly as large a benefit as the Paycheck Protection Program loan, but it adds up. It really helps a lot of people, a lot of businesses. And that got extended, and then I'll talk about it in a minute, and it abruptly expired. The rest of these, I'm not going to get into the details because most of these rules have expired already regarding the different benefits. Ask me questions in chats. I don't know if there are any, or ask me later, and I'll happy to discuss more specific items. But most of this expired. Going down to the bottom of the page where it says extended in 2021. That wasn't necessarily the CARES Act. That was sort of a smattering of items. I discussed a few of these. The first one already, that's because it came up in the CARES Act. Some of this came up in the CARES Act. It came up again in different acts. But medical expenses for individuals are 7.5%. We talked about that already. What expired and came back, it's not a huge benefit, but if you do any residential energy efficient improvements, a lot of people have already done this. There's a 500 cap. This is on windows. This isn't solar. There's energy efficient property and there's stuff that makes electricity. So this is the efficiency things. This is insulation. This is doors and windows. This is solar. Doors and windows. This is appliances. You're allowed up to $500 tax credit. Not much, but it's out there. If you haven't used this yet at all and you've made some improvements, consider using this. You get up to a $500 tax credit, but it's a lifetime cap of 500. So once you hit the 500, and that goes back to almost like 2005. So by now, most people have already used their lifetime cap, but it expired and it came back. So anyone who didn't yet, go ahead because it's about to expire again. That's in 2021. And then also the making electricity in your own home, solar panels, geothermal, wind. That one's not nearly as common, and a few of the other systems. It used to be, this is the one that people talked about for years. You got a 30% tax credit for solar panels. What a great benefit. This is federal tax credit. That was set to start sunsetting down, went from 30% to 26% to 22% to 0. They extended it to allow the decrease was pushed out a little bit. So if you see the little bold towards the last line on the whole thing, if you did this already in 2021, it's pretty much too late now to start. But even into 2022, it's still a 26% credit. It was supposed to be 22% in 2022, and it's back to 2020. It's back to 26. It was supposed to expire actually in 2022, and it's 26% in 2022 and 22% in 2023. So it's still alive in 2022 and 2023 if you think about solar, geothermal, or any other of the renewable resource systems in your own home. And we are now coming up to the last page, which is really the newest stuff. Things that we covered a few of these items. Things got extended, or they're made permanent, or they're new. We talked about the required minimum distributions. That's the first bullet. That it did not get extended in 2021. I just want to keep emphasizing that. If you have not taken it yet, or you're a family member that you know, an elderly family member that thought it was expired, it did not get extended. Charitable contributions, we talked about this one. If you are not itemizing, if you're taking the standard deduction of $25,100, you can get a $300 individual, $600 married filing joint deduction. A lot of people have done this already anyways, so just know that you get an additional $600 on top of, if you're married filing joint, on top of your standard deduction. So it's now $25,700. The big one is the child tax credit and advance payments. That was pretty confusing for a lot of people. The credit is $3,000. The rule is $2,000 per child under 17. In 2021 only, this is where things get confusing. In 2021 only, it's now $3,000 for children under 18. So my daughter turned 17 in 2021. She is not under 17 in 2021. So originally I lost that $2,000 credit. So for 1 year only, I don't only get that $2,000 credit, it's $3,000. So that was nice. And that there's a lot more people than just me. I'm giving a specific example. So for 2021 only, children under 18, it's $3,000. Children under 6, it's actually $3,600. And the income limit is up into the 400s for its married filing joint, up into the 400,000s. So that goes to a lot of people. What's making it confusing, it's going to be real confusing for people like me, the tax preparers, is this was part of the 2021 American Rescue Plan Act. This was the big one that came out in March of 2021. That's why I keep saying 2021 only, because this wasn't part of CARES Act. People are losing track, excuse me. people are really losing track of when all these different rules were passed and which is what. So that's why I keep repeating and emphasizing, and I'm going to kind of speed up a minute because I just saw the time, but I am coming towards the end anyways. Um, Folks who did not opt out, if you got your tax refund by direct deposit, that means the IRS already has your information. Good chance China and Russia does too. That was a joke. But if you, oh, we're being recorded. I shouldn't do that, right? No, but if you get your refunds as direct deposit, then the IRS already has your information, your banking information. And if you have kids that qualify for these credits and you got the 2001 in 2020 and your kids are age eligible, you've started getting, if you did not opt out, and you had to really jump through some hoops to opt out, most people did not. First of all, you had to know about this. Then you had to look into it. So those are two big hurdles right there. Know about it and look into it. Two big hurdles for most people. So most people did not opt out, and you started getting an advanced tax credit on this. So you got, since it started in July, that's half the year. So that $3,000 tax credit turns into $1,500 half the year per child for half the year, started in July on a monthly basis, divided by 12. So in July, August, September, October, November, December, I was getting half the credit for my son, half the credit for my daughter. So it's a in 2021, I get a $6,000 tax credit for my two kids. But by the end of the year coming up, I'm gonna have already received 3. In the old rules, I got 4,000 on my tax return. So there's going to be a little bit of confusion that people are going to get if you're really cutting it close and you're getting a small refund in the past, and you have 2 kids, and like I said, 4,000, you've gotten some of that. You got a chunk of that already. So people are going to say, why'd my refund go down? Now, we're not talking about a huge number. If you're getting a $15,000, $20,000 refund, you may not notice this. But if you're in that $1,000, $2,000, $3,000 refund category, your refund is potentially going to go down. And the answer is you got some of it already. But I spent it. Yeah, well, yeah. Everybody should get letter 6. And if you don't direct deposit, you should have been getting checks. And those people would know that even more. If letter 6,419 in 6419, that's tax form speak. Everyone should be getting a letter in January or February of letter 6419 that's going to say how much you've already received in advance in these credits. That number, that letter is very important. Save it for when you prepare your taxes. If you're a TurboTaxer or other product, if you have a tax planner preparer, make sure you supply that, because there's going to be a lot of confusion as far as how much did someone already get or didn't get. Because if you got nothing, you get the rest of it with your form, with your tax return. If you got your half, you don't get it again. And the IRS tends to get, this is, as much as we make fun of the IRS and give the IRS a hard time, this is one area that they usually get right. Same thing with those economic stimulus payments that were $1,200, $1,800, $1,400. Most people got those. A lot of people may not remember a year later, oh, I don't remember getting that. They got them. When they look back and they looked at the deposits, most people got those. And this is the same thing. Most people got them. So it's gonna be the cause of a lot of tax notices if you do your tax return wrong, claiming the credit that you already received. The expansion of the dependent care credit, that's for daycare if you have kids under 13 years old. On one hand, it's great. It went from 4,000 to 8,000. The credit is $8,000 for one kid, $16,000 for 2 kids, to the lesser of the cost of dependent care, taking them to daycare, or 8,000 or 16,000 for more than 2 kids. This one quickly ramps up to be reduced. If you have adjusted gross income over 125,000, it starts going down pretty quickly. So it's pretty hard to get the $16,000 credit with multiple kids on certain ages, on certain income limits. So this one we're not going to see as much. So I'm not going to spend as much time on it, and that's why I spent so much time on the advanced payments. And then the rest of it, I'm going to jump down to repeat again: meals and entertainment. Just remember, meals is 100% for 2021 and 2022. Business meals, business purpose, who, what, when, where, why, document it. Must be, again, like I said, at a restaurant or from a restaurant. Takeout's okay, and it's all through 2022. So I keep repeating it because so many people are used to the 50% deduction or not at all. And this is a great one. This is, support your restaurants. And again, it's not you and the family. It's not me and my family going out for dinner. It's not me and a coworker necessarily, um, just having lunch because we have lunch anyways. This is for employee. If an employer is taking an employee out, this is if you're taking a client, a customer, supplier, a vendor, 100% deduction. Support your restaurants. Next one, big news these days is taxation of cryptocurrency. Crypto is a big buzzword these days, and taxation of cryptocurrency can be covered in a moment. Even though it has the word currency, crypto is not currency in the eyes of the federal government, the IRS, um, or generally any other country. It may, who knows, will it be currency? Will like true currency? It is definitely a a financial product to trade. I could use cryptocurrency and get something in exchange, but it's no different. The way the taxation of this works, it's no different if I'm using stock. It's an investment in a capital asset, no different than a stock or mutual fund. If I buy cryptocurrency A, I paid whatever amount for it. If I buy it and then I sell it at a gain or loss, I get a gain. I get a short-term or a long-term gain or loss, depending on how long I held it for. No different than if I had Microsoft stock. Um, and again, no different with Microsoft stock. If I have a Schwab account and I buy Microsoft stock and I sell it and then I buy Facebook stock, Meta stock, I didn't end up with from Microsoft to Meta and there's no gain or loss. Everyone knows these rules we're all used to. I sold one stock at a gain or loss. I have a taxable transaction. And with that money, even though I never got the money within my account, I bought another stock or a mutual fund or whatever. Those same rules apply with crypto. If I buy crypto A and I sell some of it and I take no money out and then I buy crypto B, I have two unique transactions. I bought one crypto, I sold it. Even though I never got the money, I have a taxable event recognizing gain or loss. And then with the money, even though it's in an account, I bought another one. Um, that gets a little complicated because, especially with all these algorithms, and if you're a big trader, things are happening pretty fast. But you really need to track all your purchases, the dates of your purchases, to have long and short-term capital gain, long and short-term capital loss as you buy and sell. If you're truly a trader, we're not going to cover this today. There are different rules, no different than a trader, a day trader with stocks. If you're a trader in crypto, those same rules apply. Bottom line, it's just a capital asset. There's a question now on the tax form, on IRS Form 1040, the individual tax return. It's a very, very vague, broad question, yes or no. Do you have any transactions in crypto, yes or no? It's not asking what they are, they're just asking, do you? And if you do, say yes, don't say no. And they're looking for people who are not following the rules properly. And as long as you follow the rules, you have nothing to worry about by saying yes on that question. And at the very bottom, the IRS has several new products available from like customer service features for identity theft. One is you can get an identity protection PIN. So instead of using your social security number on your tax forms, you could use a PIN number now. You go on, that's the second bullet. You go online, you apply for this. You got to jump through some hoops because you got to really know, they will really want to know it's you. And once you enter the program, you will get a new PIN number every year. They'll mail it to you each year to be used the year after. You're only going to use it once. The number's only good for 1 year, but you'll use that instead of your social security number. And then the first bullet we're highly recommending for a lot of people is to create an online account. Again, you got to jump through a lot of hoops to create this account because they want to know it's you. Tax preparers, I could even create a unique account as a professional. And then with your permission, I can view your account regarding taxes paid, refunds received, balances, the history. There's been a lot of issues in the mail with checks not arriving. Everything's just gotten a lot easier. I highly recommend go to this website, create an account, and you can use it to make your tax payments. Covered a lot of information pretty quickly. I'm going to stop and answer questions. I am available. I'm going to stay on, but I just want to make sure that I ended within time. I hope everybody got something out of this, at least one or two little pieces. I highly recommend. I know I threw it out at the very end. If you're still awake, the create that account, the online account. Whether or not you do the identity protection PIN, not as important right now. If you're concerned about that identity theft, do it. But definitely create that account and then start paying your taxes online. Just a lot easier. The IRS has been very secure. All these breaches we're hearing about have not been the IRS. And I'm going to leave it at that. Let me know if you have any questions. Thank you.
Thank you, Barry.
And feel free to ask the question besides typing, whatever is best for you. You're welcome. Thank you.
Hey, Barry, one of the things I just recently being last month, applied for one of the for an IRS online account, and because I have a business cell phone and not a personal cell phone, I had to request the access code by postal mail. Unfortunately, by the time the postal mail got here, the access code had already expired, so I had to reapply again to try to do that. But if you have a personal phone that you pay for, you can do the whole thing online. But if you have a business phone, you can't. Business cell phone, you can't.
Thank you for that tip. Thank you, Mitch. And hopefully once you do it, you'll find that it's, again, back to that mail thing. It's just the mail has been unreliable and undependable. The IRS is backlogged. They have, if anyone heard the stories, they had millions of pieces of mail, millions, piling up in when the government was shut down in March of 2020. A lot of that got lost. A lot of it just was it lost, thrown out? I'm not going to be cynical. Let's just say it got lost. There's just a backlog of anything you send to the IRS by mail is taking months. So if you can do things online, I highly recommend it. The number one problem with a lot of tax notices, people don't even know why they got a notice. So step one is to call the IRS and sit on hold for hours, if you even get through, to finally talk to someone for a very basic answer and just say, oh, the answer was the check was never received. And you can go online and see that now. Okay. And you can deal with a lot of the basic problems online. So I highly recommend that.
I'm sorry that happened, Mitch. That's frustrating.
I went to use it. Sorry, this is expired. Then I looked, it's good for like 21 days or something like that. And it literally got there. I think it took 35 days, 36 days. So it wasn't even wasn't like, oh, if I'd opened the mail yesterday, I would have been able to do it, but it wasn't even close. Barry, just kind of a general question, maybe from your experience, what types of, not that anybody would condone that, what types of behaviors are driving the IRS to do a business audit these days, or a personal audit? Is there any red flags or anything that we should be, scrutinous about in terms of our record keeping and as such?
The IRS generally doesn't tell people that. That's always been internal. A lot of it's changed over the years because a lot of it's computer driven and algorithms. One thing for sure, very large businesses, large gross receipts, definitely not me. Large gross receipts kind of trigger some things. And large deductions, history of losses will sometimes trigger an audit. There's big swings sometimes, believe it or not. You had a really good year followed by a really poor year, or vice versa. It's gotten weird with coronavirus because a lot of people have had that poor year. So it changes the swings. Mm-hmm. But a lot of it's just, there's no real red flag, one unique transaction or one unique. What I always just tell people is the IRS is going to audit you. Then I'm not suggesting people jump into this purposely, but if you prepare your return and you file your documents accurately, you have nothing to worry about. Now, granted, you have the worry of an audit and the cost that comes with it, and the headache and the fear of what's going to happen. But if everything you did is right, or close to, then at the end of the day, it's a headache, it's a hassle, but you're not going to lose. It's the ones who are, even if it's not a red flag and it's not right, and you're making things up, underreporting, not reporting all your income, or over exaggerating your expenses, that's when it becomes more of a problem, obviously. The one thing I recommend is some of the non-cash deductions, things like miles, is have a log if you can. You're required to. You don't just deduct. You can't just write on your tax return. I drove 10,000 business miles. You need to keep a log of those miles. Again, the who, what, where. How many miles did you drive? When they occurred, the business purpose, and many miles. A local me. I'm an accountant. I get a W-2. For me to throw thousands of miles on my tax return I can't. I don't have the right form. But even if I did, that would be a red flag. But if they're legit, then I still have nothing to worry about. I know I kind of went around in a circle for your question, but unfortunately, there's really no one or two red flags. The biggest thing are the swings.
Well, I have a question. Thanks, Barry, for that great information. I love that document. It was a lot of all consolidated information. That's perfect. So I own a small business, and I submitted my estimated taxes for the Maryland comptroller back in September, and they still have not taken the payment. And I've contacted them. I wanted to know if anybody else has seen any delays with Maryland's comptroller.
You paid a check in September and it hasn't been cashed.
No, I submitted it online. So, and it says processed. I've checked it several times and also called them, and they said they're behind, but that was back in October. I checked and we're in December now.
And you paid like by auto withdrawal, like you paid, is the money
Yeah,
in your
my
bank?
account.
Is the
Yeah,
money in your, I'm sorry, the money is out of you, the money is still in your account?
money's still in my account. I've been doing this for years, and they usually take the money the next day.
That's weird. Yeah, I have not heard of that one. I have not heard of an auto withdrawal not happening.
Yeah, I guess there was some kind of delay or something. I'll call them again this morning. I just want to know if that was something you've heard.
Yeah, Shay, I just made a payment and it took them 3 days to take it out just this past week, but they did take it out.
Okay, well, I'll call them because this was September 15th. So, and still haven't taken the money. Thank you.
And unfortunately, if you set it up to pay it again, that's the day they're going to take both.
Exactly. And that's why I haven't done it, because they have done that before. They've taken 2 payments after, yeah. So, all right, perfect. Thank you.
We have a question here. Yes.
This is a nit, but back on page 2, it's for business deductions for entertainment, amusement, and recreation. And you also have a note here that says, including membership dues to any club organized for business. Does that mean you can't deduct the chamber dues?
Chambers are allowed. It's that one is this is more of a your social your golf club, your country club,
Okay.
things of that nature.
That's what I've always assumed. I
Mhm.
just want to see. Thank you.
And anybody else? Obviously, we're past 9. If I understand, I'm in past 10. If you need to hop off, go. But if you have any questions or something, otherwise we'll wrap things up shortly. My phone number, the top right-hand corner of the handout, it's the firm letterhead. I don't have an individual extension. Just call the main phone number, email me. My email is not on here. I should have. But if you call or check with the chamber, my email address is out here. If anybody wants it, I can give it. And if you have any questions, if you don't want to ask online, or if something comes to you later, like I said, you can't sleep, you start reading this in the middle of the night and something comes to your attention, call me, reach out tomorrow. I'm happy to help with anything.
Thanks, Barry. And we also will send out a follow-up message with your contact information
Great.
to everyone who registered today, and we can include the attachment as well. Well, thank you. That was so informative, and I'm sure people will have questions later. And I encourage them to follow up with you, schedule a one-on-one, and see how you can do business together. So again, thank you all for joining us, and we hope you'll tune into our future webinars. We have a schedule of events going into 2022, which is very exciting. All of our events can be found on our website. It's centralmarylandchamber.org, all spelled out. We do have one final event of the year coming up on this Friday morning. We're having a coffee catch-up morning networking event at the Chesapeake Think Tank offices in Annapolis from 9 to 11 a.m. Again, you can go to our website to register for that event, and that will be the last one of 2021. And we are very excited to close out a successful year and get started on 2022. So thank you again to Barry Fields with Bormel, Grice, and Huyett for such an informative presentation. And again, I encourage everyone to reach out to Barry to schedule a one-on-one or for further questions. So happy holidays to you all. I hope to see some of you on Friday morning at the networking event, and have a wonderful day.
Thank you for attending. Thank you, everybody.
Thank you.